This stock is going to get cut in half. All right. SpaceX and Tesla together are two of the best shorts at scale in the market right now. People think it's a rocket company. Let me be careful how I say this because I got called out the other day. People didn't get what I was meaning. It's not really a rocket company.
You don't have to be diversified. You just have to be concentrated and right.
Okay.
Pleased to welcome back to the show George Noble, managing partner of Noble Capital Advisors. Check out our last interview, link down below, where he's made a number of correct calls on where tech stocks are headed. We're going to revisit some of these calls today and get his updated outlook on the markets. Welcome back to the show, George. Good to see you.
Thanks, Dave, for having me. Always a pleasure.
Okay. South Korean stock market imploding. Leopold Aschenbrenner's fund imploded, got bought out by Citadel. Japan got bought out last week or bailed out by the U.S. Treasury. And we're going to talk about what happened with earnings first. So a lot to go over today. The bigger picture is whether or not the bubble froth that we've been talking about for a couple of months now, you and I, George, is finally popping. Let's start with earnings. Right now, SpaceX, arguably the hottest stock in recent history, reported revenue up 92% this year to $7.8 billion. Stock went up initially and then came down like a rock, down 12% on the day. I mean, what do you make of the fact that you have a good earning? This is not the first time it's happened in the tech space, by the way. We can draw several examples early in the year, Oracle being one of them. Okay, you have good earnings, potentially a beat on revenue, and then all of a sudden stock drops. What does that tell you?
Well, as Stan Weinstein famously once said, it's not the news, but the reaction to news that counts. A lie to that as well. Oftentimes, the first reaction is the wrong reaction. I try not to get too invested in the daily machinations of a lot of these hot potato stocks like SpaceX. It's funny, David. Of late, I've only been looking at the screen 3 times a day. I look at the opening, I look at lunchtime, and I look at the close. And it's actually made me a better investor. It gives me more of a chance to focus on what's going on. Because what happens to most investors, the shiny object is the volatility, and people just want to talk about, what's going on with SpaceX. So I guess, imagine, David, I mean, for those viewing at home, I think of my time, David and I were going to do this interview yesterday, but we only realized that the SpaceX thing was going to come out. So it made sense. David says, let's do it tomorrow. I said, fine. Imagine, though, David, if I was on with you yesterday, George, SpaceX is up 12% today. What's going on? Right? And I got to make up some nonsense. Well, it's, a lot of shorts being squeezed and this and that. And maybe there's shorts covering their position ahead of the earnings. Who knows? People always want to attach meaning to the day's price, to the day's movement, which is a fool's errand. Today it's down. It's more than given up. All right. So the real story with SpaceX is how wildly overvalued it is. It is the biggest, destined to become the biggest IPO flop in the history of markets. I've never seen such overvaluations at scale as SpaceX. That it's designed to be a doomed IPO is a feature, not a bug. And just to review, David, and we've talked about this twice. This is the third time I've been with you in the last few months. And you rightly said to me, hey, George, go with the flow. Yeah, fine. Which is why I told people when we first wrote it up, this is a pile of you-know-what, but don't short it coming out the box because people are going to be squeezed into this, index funds, grandma's 401k, the whole thing. I said, but just wait. We waited. Stock went to like 220, wherever it went. And I wanted to first make sure all the index funds were jammed in there, that buying. And also, it was a hot deal. You may have some, tourists piling in. Keep in mind, the stock opened, I think, 170, 175, went to 225. Today, I see it's at a new low, 111 and change. I think SpaceX is a better short now than it was at 175, where it first traded. I think it's a better short now than it was when it came public at 135. You could not have gotten shares at 135 unless you got on the deal. Why do I say that? Peter Lynch used to always say, you look at a company, is the story getting better or getting worse? So there's how the stock price is doing and how is the story going? Are the fundamentals getting better or getting worse? And so you could have a stock. Say we have David Lynn Pharmaceutical. We buy it at 10 because we think it's going to go to 15 because they have a new drug coming out. And, Lynn's a pretty aggressive CEO. He promotes his stock. But I seem to recall BioVale was a Canadian company too. So I don't know if it's about you Canadians. But anyway, so Lynn Pharmaceutical, they come out with their product. and the stock goes up. And so say we thought it was going to go to 15 and now it's at 13. You'd be like, well, George, you wanted to buy it at 10, it's now 15, it's 50% upside. Now it's 13, it's only 2 points upside, 15% upside. I say, yeah, but wait a second. When Lynn first mentioned the product, we thought the addressable market was going to be X number of X millions of people. Well, now there are more applications, and all of a sudden, say it was Viagra. Okay, Viagra, to remind folks, was originally designed was for pulmonary conditions. Well, then we discovered along the way it was good for erectile dysfunction. So all of a sudden, the addressable market for Viagra goes crazy. So people result on price. They look at the price on the screen. But maybe Lynn is telling us now that, you know what, we thought the addressable market for this pharma product to come out is 100 million people. Now it's 500 million people. So the stock could be a better buy at 13 than it was at 10 because we now think it's going to go to 40 instead of going to 15. How's that relevant to SpaceX? The squeeze is out of the way, the index inclusion. They made it, a very tight float. So some institutions that want to top up their positions, et cetera, fine. They're all in now. And now, and I'm so glad we're doing this today, David. I know you know this, but just to review the bidding. Tomorrow, guess what? Tomorrow, the float on SpaceX goes from 5% to 25%. So there were 85 million shares at issue. I believe there's 911 million shares that are going to be eligible for sale tomorrow. And when you consider, David, of the 85 million shares that were issued, a goodly proportion of those were taken up. Index funds bought them. Some big institutions bought them. So if you said to yourself, how many shares are held by discretionary investors, retail investors? It's, I don't know, 20, 30 million maybe. Who really knows? That's not the point. Point is, that should be compared to the 911 million shares that are to be unlocked tomorrow. Now, is SpaceX going to collapse tomorrow? I have no idea. It could be up tomorrow for all I know. For all I know, it could be up. You know why? Because all the wise guys are shorting the stock ahead of time, suggesting it's 30% of the float is now short. Probably true. So maybe it goes up, but that's not the point. David, as opposed to many, I'm not interested in speculating. We're investing. All right. So when I call SpaceX as a short at 145, and I said it's worth 30. This stock, in my opinion, you can quote me on this, okay? This stock is going to get cut in half, all right? Maybe by as soon as the year ends. So what it does next week, I don't know. But if I tell you with high confidence, in my opinion, do your own work, the direction of travel is down, southerly direction from upper left to lower right. Being concerned with what it's doing tomorrow, what it's doing today, doesn't interest me. I'm an investor. I think SpaceX and Tesla together are two of the best shorts at scale in the market right now, two of the best shorts in the history of capital markets. I'm short Tesla from 475. I'm short Tesla SpaceX from 145. People may not want to hear this. I'm interested, though, in not making them feel good. I'm interested in helping them make money and what I believe to be the truth.
Before we continue with the video, I'd like to tell you about a new opportunity to be exposed to gold and silver. Today's sponsor, ICG Silver and Gold, is one of Nevada's newest silver and gold exploration companies, having gone public earlier this year. Their flagship project is in the Tuscarora district, a district-scale silver and gold project sitting at the intersection of two of Nevada's best-known gold belts, the Carlin Trend and the Independence Trend, with both open pit and underground potential. The project sits only a few kilometers away from First Majestic's Jarrett Canyon mine, which is on track to restart production next year. The Tuscarora district is an advanced exploration asset. There's more than 40,000 meters of historic drilling on the project, including a past intercept of 4.57 meters of 127 grams per ton gold and 1.5 meters of 367 grams per ton silver and 52 grams per ton gold. The company is now drilling 3,000 meters at the first 10 targets and is aiming to release the project's first inferred mineral resource in the first quarter of 2027. To learn more about the project and the company, check out the link in the description down below. And as always, review the company's filings and risk disclosures before making any investment decisions. Okay, I'm going to read you a paragraph of this article here, and then I'll ask my question. SpaceX hit by surging AI costs. Okay, so for a rocket company, SpaceX is spending a lot of money to build out its AI capacities. Too much, according to investors. The company reported revenue in its first quarterly update as a public company that surpassed analyst expectations. I mentioned that earlier. But the stock went down, George, because most of its revenue came from Starlink satellite offering, and investors turned to capital expenditures related to its XAI unit, which runs the Grok AI service. Those hit $15.8 billion, higher than expectations of $13.9 billion. My question, $13.09 billion. My question is, maybe now this is evidence of perhaps the market froth going away and hype going away. Because a few years ago, if you had told me that the markets would react to CapEx spending rather than just hope, I would say that's crazy, right? This part of the market is bought by hopium, and investors buy it because they expect SpaceX to one day be bigger than Earth, or in the case of Tesla, one day Tesla will be something greater than Ford, even though they never made as much money as the American car companies. Anyway, my point is Tesla lost money for many years. Stock still went up. Nobody really cared fundamentally about costs, I guess, until now, right? Back to fundamentals, are we?
I believe so. But again, to try to attach approximate cost, the reason the stock's up or down a given day, don't really know. What you say
Yeah.
makes sense. They're looking at a prodigious cash burn. As you know, they issued bonds a few weeks ago. I don't think this is on what SpaceX is doing. Okay. There's no profitability in sight. This is a publicly traded science experiment. People think it's a rocket company. Be careful how I say this because I got called out the other day. People didn't get what I was meaning. It's not really a rocket company. It's really an AI company. If you look at they suggested a 29 trillion dollar TAM when they came public. Three-quarters of that is from AI. So the real driver here, the cash burn and everything is from the AI side of things. Okay. It's nice to talk about Starlink. It's nice to talk about the rocket business, but that's not what's really going to move the needle here, either in a positive or negative direction. So it's really an AI play with starting to say, well, it's the integration, George. You don't get it. You have to merge the rockets with the Starlink with the AI, and it's the only integrated, blah, blah, blah. It's a cash burning AI play. All right. And it's sort of the mannequin in the window, which attracts attention. Oh, the rockets are cool. Look at this. Elon's done things for humanity nobody else has done. Yeah, he's lost so much freaking money as well. The whole thing is fanciful. All right. He's capitalizing on what I would call low information investors who aren't looking at the numbers, aren't looking at the valuation. All right. And now, as you rightly point out, David, I mean, listen, this company's got, what is it, still like $1.4 trillion market cap? The revenues are like, David, whether they made or lost 2 billion, 4 billion, 6 billion, 8 billion, who cares? This is a company, all right? They did $7.8 billion in the most recent quarter. Oh, it was a beat. They beat by 980 million. David, annualize that's 32 billion. The market value is 1.4 trillion. Like, in what world does that make any sense? So everyone's going on about this, about that, but you're right on the cash burn because they keep spending money like cash. They're going to need more cash. They're going to have to come to the market, issue more bonds, maybe sell stock. So this was an IPO just built to fail, built to fail. And I called it out. We wrote a piece on April 29th. It was on X, got 1.7 million impressions. It was the axe on the piece. We laid it all out. And some of the parts I want to remind folks that, well, you have Elon derangement. I said, no, I don't. No, I don't. And anyone who says that to me when they start with the insults and helmet attacks, that's a cover for the fact they can't defend their position. So we go through the numbers, and okay, Starlink, good business, worth a couple hundred billion, whatever. You then look at the rocket business. You look at the AI thing. You come up with, like, I don't know, $400 billion maybe, 300, 400, whatever, some number like that. Maybe it's 500 if you're in a good mood, 200 if you're in a bad mood. So let's take 400 billion, all right, or 500 billion. You come up with $25, $30 a share. And whether the quarterly revenue came in at 7.8 billion or 8.8 billion or 5.8 billion, doesn't matter. Then you have people like Gene Munster. I'm going to call him out. Nice guy. He's had a lot of great picks over the years. But look at the analytical malpractice he's engaging in, all right? Just to gain eyeballs. The guy must have posted 15 tweets on X yesterday. It'd be like me saying, like, well, I actually think the outlook for SpaceX, they're going to use blue-colored rockets instead of yellow-colored rockets. Like, does anybody really care about that? No. The bottom line is liars figures don't lie. 1.4 trillion, accelerating cash burn, $32 billion in revenues, and now the float is going up by 5x tomorrow, and it's going to go to 50, 100% over the ensuing months. You're saying 7% incremental unlocks over the next few months. Think about it, David. Anybody who bought stock on a private basis in SpaceX, $10 a share, $20 a share, $30 a share, they all know it's overvalued. And now you have a chance to sell at 110. So, like, what do you think's going to happen to the price of the stock? And then on top of it, wait, there's more. There's no valuation support. The chart's broken. So all the FOMO guys, it's like, wait a second. And I'm gonna tell you this last, Dave. I don't know if you're single, married, whatever. I'll tell you a funny story. You're gonna love this one. So I became available, shall they say, in the last few months. I broke up with a wonderful woman. Sad it ended. So I'm back on dating. Okay, I'm on Bumble. All right. Dave, maybe you can introduce me to some nice ladies. Okay. I'm on Bumble. I can't tell you. I probably went on, I don't know, 2, 3 dates. I've been on like 46 dates. Okay. 46 different women. 2 or 3 dates. I had these chicks asking me about SpaceX. I'm trying to sweet talk them and they want to know about SpaceX. Tell me that's not a mania. Anyway, you heard it here first. I've been on your show twice. I'm saying it again. Lest you think you missed something. Well, George said to short it, but I didn't
Right.
short it. It was a 1045 cent one day. This sucker's going down.
All right. Tell us about how to use leverage responsibly, if there is such a thing. Because apparently that's the issue here with situational awareness meltdown. It's not. Okay, so people are arguing here about what actually caused Leopold Aschenbrenner's fund, $45 billion fund, to basically go into a fire sale a couple weeks ago. Citadel bought out most of its shares. Okay, so what happened here? According to the Bank of America CEO, Brian Moynihan, he called this a near collapse of the hedge fund an issue of leverage, right? These are all warning shots. Moynihan told CNBC's Andrew Ross Sorkin, valuations get out, leverage in the system gets there. You have to be careful. And then I was just reading Business Insider had a separate article about what went wrong here. They've offered some theories as author. So he had too many eggs in too few baskets. Okay, that we know that. But it says here, you could be right on your thesis, but still wrong on execution. Where's that paragraph? Yeah, here. It's entirely possible Aschenbrenner's overall investment thesis was right. After all, his original paper predicted many ongoing trends, but he ran into an unfortunate reality of high conviction investing. You can be right and still lose. Have you ever encountered that in your experience? Being right and still lose?
Yeah, but as George Soros famously once said, and I'm going to bastardize the quote, but it wasn't so much. I think Druckenmiller said this as well. It's not necessarily what your batting average is. It's when you're right, how much do you make? And when you're wrong, how much do you lose? And there are great investors. I'm going to cite Bruce Kovner as one, who, fantastic investor, one of the best of all time. He was a commodities trader, he was a trend following guy. And he would tell you that most of the time he was wrong. However, he was a trend following guy. You would understand this, David, rather most investors would understand this. When he was wrong, he cut it immediately. There was no emotional attachment to what he was doing. And you size the position in a way where you have to countenance the idea that something could go horribly wrong. So you limit your losses. Flip side is when you're right, if you're trend following, you keep following the trend, following the trend, following the trend with stop loss. And the minute it goes the wrong way, you're out. So it's not necessarily whether you're right 60% of the time, 40% of the time. And Kovner would say, I think he was wrong. He was only right 30% of the time. But when he got it, he really got it. To use a baseball analogy, David, his slugging percentage was enormous. So in the case of, what is it called? The situationally unaware fund? I am appalled. We've seen this movie before. This is absolutely outrageous. I don't know Mr. Aschenbrenner. I will just say that some of his past affiliations were a bit questionable, to put it mildly. I think he was at scam bankman frauds thing for a while, and then he was at another place. I mean,
He was at OpenAI. He was a researcher. Yeah.
Okay. Now he has to be a smart guy. You don't get to be a valedictorian at Columbia and graduate at the age of 19. So 10 times smarter than I am. That's not the point. But clearly, the guy knows nothing about risk management. Clearly, by dint of you say you can judge a man by his friends. Well, look at his former colleagues. That's not a crowd you all have anything to do with. All right. So bright guy. Maybe he totally knew what he was doing. Maybe he didn't. I don't know. But the one I really have trouble. The thing I really have trouble. The real message of the story here is who gave him the money. And you look at some of the investors who invested in him. This is not new. Where were the adults in the room? Okay. And this is actually a really important. I'm really glad you asked this question, David. This is symptomatic of what's going on in the market right now. that you have a 24-year-old kid. And look, I wish I was young too. I got gray hair. All right. I'm not besmirching youth, but like at 24, like what the hell do you know? What did you know at 24? What did I know at 24? All right. And that he was given this much money to manage. And then you got the prime brokers who are extending all the leverage to him. Like, come on. Now, were there any laws broken here? No. But there was a ton of bad judgment. Ton of bad judgment from Goldman Sachs and Morgan Stanley and the rest enabling all this. They're just after the fees. They're in for the money. Ton of bad judgment on the part of Mr. Aschenbrenner. Ton of bad judgment on the part of his investors. And he is not the reason. Now we're going to generalize. We're going to zoom out. Yeah, people say, well, the whole reason now we know why tech stocks blew up. It's because of Mr. Aschenbrenner. Well, wait a second. So you're all complaining. So, oh, it's a one-off. Now we know why it happened. It's all good now. He puked. It's all good. We can go back in. I sent you a
Okay.
chart this morning which showed the options
Yeah.
being purchased again, right?
I'll pull
Hey,
that up.
David. Hey,
Yeah.
David. Do you think some of the buying from Mr. Aschenbrenner and folks like him maybe had a little bit to do with why it went up? So they weren't complaining when it went up. Now you're going to complain when it goes down. The point is, he got rinsed. He's out of business. I mean, he's got David. Think about this for a second. If you back out his Anthropic stake, he's basically a zero. He's a zero. He lost probably more than 100% on his publicly traded equities. He was up whatever it was, 400 some odd percent at one point. All right. The only asset he's got left is Anthropic. So he's probably more than 100% loss on his publicly traded equities. So to me, it's symptomatic. Just had I'll stop. The dangerous situation is, and if you think Leon Aschenberger is the only guy who recklessly speculated, David, you highlighted it the last time we were on. So I think 1 in 30 adult Koreans got margin called or whatever. Everyone was
Yeah.
doing. He's just the most high profile example of who got caught. That's all.
Okay, look, everyone at some point loses money. What happened here was apparently he was up 439%, hailed as an AI genius in the investment world. Then apparently 4x leverage wiped out 67% of his fund in 1 month. Fire sale happened, Citadel stepped in, bought it out. Okay, how do we manage risk is my question. Because in theory, had he managed his positions properly, and I use the word properly subjectively because that could vary depending on who you're talking to, this wouldn't have happened. He would have suffered some losses, paper losses, had he not sold, but he wouldn't have had a fire sale. He wouldn't have gotten margin call in some positions, all right? Walk us through how you would have done this.
Right. Okay. And by the way, his fund was actually more than 4 times levered, the way I look at it, because he had this big Anthropic holding. So if he had 10 billion in equity and 35 billion in debt, whatever it was, he was levered. And so he had a huge portfolio of publicly traded equities. So the leverage just on the publicly traded part was even bigger. But I digress. You have to. Investors typically use. I know you're familiar with this, David, via a VAR model, value at risk. So you say to yourself, okay, what's the implied volatility of this portfolio? What can I reasonably expect it to go up or down? And then, if it goes down the max amount that I think it could in one day, what the computer says, how much would I lose? Okay. He clearly was not using a VAR model. All right. It's always number go up. Yeah, upside volatility, fine, but they know where everything downside volatility can manifest. All right. So how would I have managed it? I mean, being levered 4 times X on this garbage, which probably has a beta of 1.5 or 2. You're 6 or 8 times notional on the stock market. It's crazy. No institutional investor does that, at least the way he does it. Yeah, there are people with pair trades that do it. But to be naked long, and then he tried shorting some stuff to hedge himself out. So how would I have done it? You want to use leverage? No responsible hedge fund guy I know in cash equities would ever be 4 times levered on high octane stuff. Okay. If I was the risk manager of that fund or any responsible risk manager, you want to use some leverage? Maybe be 150% levered, 200% levered, whatever. Okay. But then here's the real part. And we used this phrase last time we were together, David. I said to you, little I know Mr. Aschenberger was going to reveal himself. Whenever you see debt and hubris, run, don't walk. We had copious amounts of both in this particular case. The market humbles all of us. For people who are going to throw stones at me, I'm telling you, I have made so many bad mistakes in my career. This is not about being right all the time. This is about being right more than you're wrong. And when you're wrong, make sure you don't get carried out. Okay. Mr. Aschenberger and his colleagues had no concept of risk management. The investors who invested with him were blind to the whole thing. The brokers, they
Yeah.
leveraged, they got in there. And then last point I'll make on this, for people say, oh, Ken Griffin Citadel brought him down. No, they didn't. This is another widely debunked claim by idiot fool investors who've only been investing since COVID in the last 5 years. Oh, Ken Griffin was calling for a rate hike, and then once it crashed, he then swooped in. Nonsense. That's not how this works. How this works is Leon Aschenberger had no business doing what he did. And the last thing I'll say on this history is replete with numerous examples like this. I'd like to draw your attention, David, to everyone should look up online, and you may want to pull up Ryan Jacob of Jacob Asset Management. Okay. I remember it like it was yesterday. The guy was up like 200% in 1999. Not as much as Leon because he wasn't using as much leverage as Leon, but he was up 200%,
Yeah.
pulling the same stunt. Okay. And the fund then went down like 99%. So there's nothing new here. There's nothing new. What's new is we don't have enough investors with gray hair who've seen this before who are aware this can happen. And oh, by the way, and what do we do now? I believe there's still a lot of people who are in this trade. And it's not just the graph I sent you. There's one the other day which showed record amounts of buying in semiconductors, all right, in tech, all right. If you want to be bullish on tech, and I could be wrong on tech, you don't want to see this. Buy when there's blood in the streets? Nonsense. Right now, they're doing it again. I put something the next day, a wise guy correct, buy when there's blood in the streets, Baron Rothschild, please call your office. No, sell when there's champagne in the streets. And that's what we're seeing right now. All right. They think everything's fine now. It's not fine. Go back to our last interview. We talked about rising bond yields. Michael Howe, please call your office, decreasing excess liquidity, calling into question the economics of the AI trade, token prices dropping, what's happening to CapEx. So Leon Aschenberger is just he's a bug that hit the windshield. He was not the problem. Okay. My own personal view. I mean, life is not linear. Things don't go straight up. They don't go straight down. We're rallying right now. How far this rally goes, I don't know. But I think all the reasons for being bearish on tech still apply.
Okay, and just to be clear, I'm not trying to pick on Leopold here. We're just using this as a sort of a case study on investing. Evaluate the next statement, please. Okay, I've heard this a lot when I was younger. I'm hearing it now. I think this sums up the philosophy here. You don't have to be diversified. You just have to be concentrated and right.
Okay. Stanley Druckenmiller, and Stan, I hope you're watching this. I'm going to call you out. You are the GOAT. The two investors I hold in highest esteem anywhere are Stanley Druckenmiller and Peter Lynch. They do things differently. Okay. Stan would always talk about you can put all your eggs in one basket, but you got to watch the basket really closely. You got to know what you're doing. Not everybody can be Stanley Druckenmiller. Everyone wants to be Michael Jordan. We can't all be Michael Jordan. There's only one Stan Druckenmiller. So you have this superficial knowledge. Oh, I'm going to be Stanley Druckenmiller. Hey, watch this. It doesn't work that way. I try to do it. It doesn't work. Okay. We're mere mortals. All right. So the philosophy you just espoused, that you just repeated, again, I think it's probably largely embraced by people who are not knowledgeable about financial history. And again, I wish I was young. This is not what this is about. I'm against financial ignorance. I urge everyone to go back and read Extraordinary Delusions and the Madness of Crowds, which chronicles the great manias throughout history, the Dutch tulip bulb mania, South Sea bubble, et cetera, et cetera. Or go read Jesse Livermore, Reminiscences of a Stock Operator, okay? And read about what the speculations were like in the Roaring '20s. So, yes, I agree in principle with that statement, but it's easier said than done. And history is full of examples where this ended disastrously for people. The last I'll say in that regard, markets have a way of attacking crowded positions. So witness Mr. Aschenberger. When you know there's a whale that's stuck and the market starts to get wind that the whale's wounded, it will attack. It will short those positions, all right? So being concentrated, and trust me, I've done this before. I've done it with great success. I've done it and I really ran into a wall. Easier said than done. Not everyone can be Stan.
Thank you. Let's move on to markets now. Not everybody can be Stan. Not everybody can be right all the time. Before I talk about this chart, then just follow up. What would you consider a diversified portfolio? See, in business school, the textbook says 40 stocks. I don't know. I can't remember how they got to that number. There was some math behind it. Anyway, people are different. Everyone's got a different philosophy here. What is a diversified portfolio to you?
I think it depends on who you're talking about. For an individual, 20 stocks. Because let's keep in mind, David, there's also the issue of like how many things do you actually follow carefully? It's one thing if you're an institution, you got a team of analysts. Yeah, you could have 30, 40, 50, 100 stocks. But there's also the point, you reach the point, Peter famously would talk about diversification, not diversification, diversification. You have too many names. I had one fellow who worked for me. He'll sure remain nameless. He's in the Federal Witness Protection Program. He's a good investor, but he always had too many names. So what happened? He's come with a great idea. He only put 1% in it, and it goes to 50%. He made 50 basis points. Great. So he would make it to the point he could generate good performance because he had too many names. Similarly, Peter Lynch, and I'm sorry I keep mentioning him, but and for all you clowns that want to throw stones at me, you know what? I was very lucky to have him as a teacher, and I'm just trying to pass on to you what I learned from him. People would say, well, he had 800 names. Like, how could he do that? Well, what they often overlook was he might have 10 names, 20 names that account for 40% of the portfolio.
Yeah.
So the top names were doing all the heavy lifting for him. And the other ones, much smaller, a lot of little positions. I'll tell you one funny story. He had a lot of little positions. And I remember there was one week he went on vacation, and a friend of mine, Dan Frank, and we were put in charge of the portfolio, and we were just caretakers. We weren't supposed to do anything. If something came up, we'd call Peter, but whatever. I could sit in Peter's chair for a week, right? So it was like, he's got these 800 positions. It's a great story. So it would be like Danny and I'd be like, wait a second, he's got 1,000 shares of that, 10,000 shares of that. What is this? So we get rid of like all these little things, right? Thinking he wouldn't notice them. Comes back. He's like, George, why did you sell XYZ? You know what he did? He bought them right back. All right. So the point about diversification, Peter used those as starter positions just because if you're thinking about buying SpaceX or shorting SpaceX, have 100 shares in the portfolio, long or short. I trust you. Trust me. When it's on your screen, and this happens to all of us, if I was thinking of buying SpaceX and I bought 100 shares, it could be like the tiniest position in my portfolio, but I promise you, if it's going down, that's the position I'm going to be looking at. So, to come back to the diversification question, I think an individual investor, as you only can follow so many stocks at once. So whether it's 20 stocks, 30 stocks, that's fine. Institutions, it could be 100 stocks. There's one successful firm that I knew that in Boston, they had a discipline. They limited themselves to 30 stocks because they didn't want to overly diversify. So, say, David, you're the analyst at this firm. You come along with an idea.
Yeah.
You got to pitch the idea. You want to put that idea in? Well, one's got to come out. So that kept the fund focused on their best 30 ideas. So that would be like roughly their equal weight of 3% positions. So, for individual, 20, 30 names. For institution, it could be 50, 100 names. If you're Stan Druckenmiller, it might be 5 names.
All right, let's get into let's finish off on your the names that you like. You don't have to name specific names, but what do you like right now? I'll share this post with you, with the audience here. This is something you posted on X. Sell when there's champagne in the streets. There, I fixed it. You're referring to the Zero Hedge tweet. There's your epic buying panic blow off top. Yesterday, over 4 million S&P call options were bought, the highest level ever recorded. Well, there's a bullish indicator, if ever I saw one. Unless I'm wrong on that.
Well, hold on.
Let's comment on this.
Yeah. So it's bullish insofar as the public's voting with their feet. The public's wildly bullish now because we had the correction, and we're having the 14th truce. And the whole reason tech went down was because Leon Aschenbrenner was forced to sell, and now he's out. So we're all good. We're all good. Forget about the fact bond yields are rising. Forget about the fact inflation is sticky. Forget about the fact there's no truce in sight for the Straits of Hormuz. Forget about the fact that token prices go down every day. Forget about the fact that the CDS spreads, the credit spreads and CDS go up on the AI guys every day. So the wheels are coming off the AI trade. I said to you last time, and I still stick to it, this is going to be, in my opinion, the biggest misallocation of capital in history. We can get into this model, that model, but you've got price cuts. Each one's out. My price is lower than yours, David. Then on top, we look across the street. Chinese are 95% off, and their models are good enough for 90% what you need to do. So we only need to use the frontier models for a small percentage of it. and blah, 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 blah. Okay. I think semiconductor stocks are a fabulous short. I like them. I'm not sure I did this last time. I don't think I did. To me, they're shipping stocks. They trade like shipping stocks. You sell them when the PEs are and the profits are high and the PEs are low, and you buy them when the profitability is low and the PEs are very high. I'm in shipping. I actually like shipping. I'll morph into what I like. I put out a piece yesterday on Starbuck. It's in my paid Substack. For those of you interested, I have 80% of what I do is for free. It's on Substack. I'm also on X. I also have a paid Substack, not to mention the conferences, David, which you're well aware of.
Yeah.
And when it comes to shipping, as you can imagine, the tankers are going crazy right now because you can't run the vessels through the Straits of Hormuz, and therefore the ton miles are way up, and so the demand for shipping is way up, so the rates are way up. And so, a couple of shipping stocks are like Okeanis, the tanker guy out of Norway, they traded totally on spot. David, this stock's like $60 a share, OET. Pull this up for a second. Pull this up, OET. All right. It's a really well-run company. It's Norwegian. It's listed on the New York Stock Exchange. All right. I think they just printed $6.25, $6 plus or minus yesterday in earnings. All right. You annualize that, and they're telling you, by the way, the next quarter is going to be even higher. But just annualize that quarter. That's $24 earnings. The stock is at 60. It's at 2.5 times earnings. The dividend yield is, I don't know, 30% or some crazy number like that because they're paying out all the income in terms of dividends. Well, there's a reason the stock trades where it does, only 2.5 times earnings, because anyone who knows shipping knows that these day rates are unsustainable. It's a commodity, capital intensive commodity business where the if the Greek and Norwegian ship owners, those are the main guys in shipping, decide, oh, the outlook looks pretty good, they're going to order more vessels. So these excess returns are going to be arbitraged away. It's only a question of time. This may go on for a year, 2 years, 5 years. We really don't know. That the day rates will go down, and the shipping values will go down. So no one values the shipping stock on PE. It's insane. You get thrown out of an introductory finance class if you do. Instead, you look at book value, net asset value, and you try to do a discounted cash flow as well. But what the semiconductor guys are doing, they're saying this is normal. Like this is going to continue. No, it's not. No, it's not. Look at the big increase in revenues you're seeing for a lot of these guys. It's more price than volume. They're jacking prices. It's a shortage. You're seeing already. David, you tell me, you read this stuff. I watch you every day. And everyone watching the show should watch David every day. Chinese are increasing capex like crazy on semiconductors. You had that IPO that just came out recently, that whatever, a CMXT thing, whatever the hell it is, okay? The orders are there. This is when you're supposed to sell these stocks. You sell when the order books get full, all right? And so
Yeah.
that's the big mistake I think that investors are making with semiconductor stocks. The hyperscalers, and by the last point on this, I know I talk too much, but if you're a vessel, here's another point. You're a vessel owner. If you have David Lynn shipping and the guy's reckless, he just loves bull markets, can't afford to miss the party, and he goes and he pays top dollar for new vessels because he thinks trees are going to grow out of the sky. So he pays up. The new build prices are up 30% because the Koreans are screwing in once a vessel. Well, guess what? When David gets delivery of those vessels, he is now the high cost operator because he's stuck with these vessels he bought at a very high price. All the other guys bought them at much lower prices. Okay, so you're running these data centers and all this stuff. You're paying up for this. I'm telling you, in my opinion, the value destruction is going to be absolutely epic. So what do I like? I actually do like shipping, particularly bulk. I like energy. Energy is up 30% year to date, if not more, despite the pullback we had. I've been very public about the names that I like. You don't have to be a rocket scientist. Just buy energy. Energy is still only 3% of the S&P. It's less than half the market index weighting of Apple or Nvidia. I
Okay.
like gold and gold miners,
Yeah.
short bonds. So still reflation broadly defined.
All right, that was perfect. That summed up my next question. What you like? You already talked about what you don't like. My final question to you, based on the things you like, some of the commodities, gold miners, gold, etc., aren't you concerned about rising interest rates, the yield curve steepening, pushing those trades south?
Yes. Answer is yes. Okay.
Okay.
So I think I have longs and I have shorts. What I believe more strongly than where the index is, I would say, well, is the S&P going up? But I don't know. What I do know is I think semiconductor stocks are going to crash. I think tech which, keep them in mind, by the way, not just tech narrowly defined for 40% of the index, but you take like, Amazon, which is in consumer discretionary, and Netflix, which is in communications. Those are really tech stocks. They trade with tech. And you take Caterpillar. I know you talked about this on the show the other day with Dave Nikoski. You take Caterpillar. That's trading like a tech stock, right? It's trading with the AI trade. So you've got maybe 60% of the market that's trading with the tech trade. And what I really believe is if you own financials, energy, healthcare, and a hodgepodge of other stuff, and you're short this tech stuff, I think you're going to kill it. All right. Now we get a big tech fallout. And I urge everyone, I had Ed Zitron and Julian Guerin and Nobody Special last week. I urge everyone to go watch that video. This is the best AI discussion in the history of the world. Chamath, Olin podcast, bring it. The technology IQ of my panel, it's not me. The technology IQ of my panel runs rings around you guys. It's a fact, not an opinion. All right. And the tech trade comes really unstuck. I think the economic fallout of that is going to be ginormous. Probably bring on a recession. Recession is not my call right now. So yeah, there's risk. So I really believe, I think energy for the next 5-10 years is going to be a home run trade. Copper, gold. So I'd hedge it by shorting SpaceX and Tesla and CoreWeave and the neoclouds and all the other garbage I can't stand, and selected consumer stocks. So it's the index I don't know because I can't tell you how it's going. And to be fair, Dave Nikoski said it better than I ever could. Market's broadening, breadth is great. What's not to like? But so looking at the index again, Peter Lynch, please call your office. It's a market of stocks. All right. So know what you own. All right. Run, don't walk from tech stocks.
Thank you, George. Appreciate your update as always. Tell us where we can follow you, and you mentioned your summit as well. Do we have another one coming up?
Not yet. We'll have one in the fall, but if you want to know more of what I'm up to, go to my Substack, The Noble Update. A lot of good free stuff there. Be grateful if you support us. We have a Substack. You can subscribe. We also have we have a podcast summary product, which is great. We give you for $99 a year. All right, you're getting 40 podcasts a month summarized in 40 minutes. Huge time saver. Keeps you up on what's important. So I'm on Substack. I'm on X. And I'm trying to help people with investor education. Yes, I know I have strong views, and I know I'm wrong a lot of the time. The market teaches us all humility, but I remind folks we're in a business where if you're right 60% of the time, it's a great result. And I'm usually able to live up to that. I spectacularly failed a few years ago. I had a horrible ETF. You learn.
Yeah.
Move on.
Yeah.
So
the Noble
anyway,
ETF. We can talk about some of the
David.
lessons you've learned over your career, but I appreciate you sharing your wisdom with us, George. Thank you so much. We'll put the links down below. Make sure to follow George there, and we'll have George on again soon. Take care for now, George.